We now turn our attention to the final piece of the puzzle. We have already seen the risk-free rate. We've already seen the equity risk premium. We are now going to look at the third piece of the puzzle, which is the beta. The beta of the stock is essentially what we call as the systematic risk that a particular stock adds to a well-diversified portfolio. That's the standard definition under capital asset pricing model. It's a parameter which is unique to each security and perhaps one of the most important concepts in this traditional finance that we're looking at now. This is a measure of the risk of the asset, a stock, with respect to the market. In other words, it is the risk that the stock will add to the market portfolio. Remember, we are assuming that there's a fully diversified investor who's sitting here, and that market portfolio is going to add a new stock. The risk of that stock is what is called as the beta. Now, how do you get to this? The mathematical formula is obtained by standardizing covariance between the asset returns and the market returns, and then dividing it by the market variance. In other words, covariance of the security and the market returns divided by covariance of the market returns with itself. Covariance of the market returns with itself is the variance of the market. Now, the mathematics aside, we don't need to really get into this detail of the formula. It's the amount of times an asset's return will be that of the market returns. What does that mean? It means that if the beta for a stock is 1.2, then historically it has moved about 1.2 times the underlying market. If the market goes up by 10, the stock is likely to go up by 12%. If the market goes down by 10%, then the stock is likely to go down 12%. Thus, what is assumed is there is a linear relationship between the stock price and the market index, right? So if you have the market return here, then you are saying that the stock return is moving beta times the market return and maybe plus some constant, right? In other words, you are saying y is equals to mx plus c, which is the equation of a linear relationship, correct? If you remember mathematics, we used to use this equation, and this equation can be found by a simple linear regression. So if you take two data points, the returns of the stock versus the returns of the market, and you do a regression on them, you calculate a regression on them, that's going to give you this equation. The slope in this particular equation is what is going to be the beta, right? The slope of this equation is what is going to be the beta. So it must be possible to find using this regression what is going to be the answer, right? And that's what we're going to try and do that. Now there are two ways to calculate the beta, and we're going to practically try and approach that entire calculation. The first way is a historical calculation. The stock returns need to be regressed against the market returns. The slope of the regression line, we just saw that y is equals to mx plus c, is going to come in. There are three decisions that you have to take. What is the length of the estimation period? Are you looking at 1 year, 2 year, 3 year, 4 year? What kind of data? What is the return interval? Are you looking at daily data? Are you looking at weekly data? Or are you looking at monthly returns? Right? And what is the market index? Are you looking at the Nifty, or are you looking at the Sensex, or are you looking at the BSE 200? What is the index that you're choosing, right? Now, typically, if you're looking at this return interval, as you move from daily to monthly, the the volatility decreases. A stock can be extremely volatile day to day, but on a weekly basis, that volatility goes down. So it gives you slightly better estimates over the longer period, right? Again, length of estimation period, longer periods typically give you better estimates, because in the last 1 month, the stock could have been extremely volatile purely based on some news, right? Now, there are some functions in Excel which basically directly give you the data points. You can calculate the slope of a line using a function called slope, or something called as line est for line estimate. You can also do a regression, but the regression is anyway going to give you the same data, so we can directly use these functions which are available. And we can also calculate it using this formula of covariance versus variance, right? So Let's try and see this calculation for any particular company. Let's try and do this for Reliance Industries. We need to choose an index. We can choose the BSE Sensex for that. And we need to choose a return frequency. We can say daily or weekly. And let's take 1 year data, the last 1 year data, right? Or data starting on a particular date till today. We can use that data, right? So we can go to either NSE India as a website, or we can go to Yahoo Finance as a website. Let's try and look at Yahoo Finance. So you go to Yahoo Finance, and then you can basically just type the code of the stock here. Let's say we type Reliance. It'll give you Reliance.ns, which is the equation for the Reliance listed on the NSE exchange. And if you look at this page, you can find historical data here for this particular company. Let's click on historical data, and we get the historical prices. We can get data from a certain date to a certain date. So we get the data for the last 1 year as we look at this data, and we can just calculate what's going to be the data, and we can download this data. So once you download this data, it gives you a CSV file. We can open this file. We get all this data on Reliance, and it gives you open, high, low, close, volume, adjusted close prices. We just need the adjusted close prices. So we can take this, delete everything else. So we'll leave it here. This is the Reliance data that we have. If we need, we can name this Reliance here and leave it here. Now we go back to this, and we probably go to the BSE index, and we try and get data for that in terms of the Indian markets. So we could type BSE Sensex, and that's the S&P BSE Sensex index that we get. And we can once again click on historical data and get the historical data for the last 1 year. We can download this data, and that gives us another CSV file. Once again, we get data for open, close, etc., and we get the data around that. Here I think we have not been able to download the entire data. What it seems to be doing is it seems to be giving us data for a month at this point of time. So let's try and get this data for a year before we go ahead. Yeah, so there seems to be a bug there. We can just put in, we'll have to put in the start date. Let's say we put in the start date as month 07/19/2015, and we put in as 07/19 as 2016, and put apply this, and click on apply. We get the prices there, and we can then download the data, which will give us possibly the data for the year. That seems more like it. So we get the data for the last year. Let's look at the last row. That's 20th of July that we get as the data, right? I can close all of delete all of these. That's the Sensex data, or the BSE data that we have. We can now redo this for Reliance, because it appears that even that has not given us the correct data. So we can put Reliance.ns and go to historical data. Very quickly put in the dates here as well, which is 07/19/2015, 07/19/2016. Apply, get the data, download the data. Let's see if this gives us the data now. That gives us the data as well. So we have the Reliance data as well. I can again delete all this, and we then take this data to our relevant worksheet, right? So I take a Control C, and we take this data to the worksheet that we're going to use. I'm going to put this data here. That's the close for Reliance. We need to put in the BSE Sensex data here as well. Where is that? This is the data for BSE Sensex. So I'm going to take this entire data and put this here, right? There seems to be some discrepancy in terms of the data that is available. So sometimes, they don't give data for certain days for the index, but they might have given the data for those specific days for the stock. and some data could be missing. We're not going to really get into this detail at this point of time because that's a matter of only a few days. So I'm going to delete this part of the data, and we're going to rely on what data is available to us on the other days and stick to that part of the data. Maybe some data is missing, but that's a certain number of days. Also note that this is in an order that is the newest date is the earliest one. So I'm going to try and sort this, and I'm going to sort this by the date where I would want oldest to the newest dates, and we do that calculation. So we get oldest to the newest data. I will also format this data and put this in a format which is slightly more readable. Now we need to calculate the returns on this. As we calculate the returns, we will calculate the Reliance returns, and we will calculate the Sensex returns, and then calculate our discussion in terms of, continue our discussion in terms of what is going to be the covariance data, right? So let's look at the Reliance returns. That's today minus yesterday divided by yesterday minus 1, or in other words, I could use today minus yesterday divided by yesterday's price. That's how we calculate the return. I can do that for the Sensex as well. We can convert this into percentages, add a couple of decimal points, maybe 1, and drag it down. Those are all the returns that we have, right? Now, how do we calculate beta? Remember the formula, beta is covariance between the asset return. So let's say we take covariance P. The asset returns covariance is a formula that will use two of these. So as array 1 and array 2, that's the covariance formula that we put in, and we divide it by the variance of the market, right? So we use variance P, and that variance of the market is Sensex returns, and we get the value as this. So we get this value. It interestingly seems to be a negative value. Right now, negative betas don't make sense, but that's what statistics can do for us. In fact, that's a good example of what we can do. We can also use this function slope, right? Remember we said slope. So let's use this function slope. Known y's, y is equals to mx plus c. Y is the stock return. Known x's, x is the market return or the index return. Enter, and we get the same value that we were getting earlier, right? And you can use the same in the form of this function called linest, and that's also going to take the same known y's, known x's. So known y's is the stock return, known x is the market return, and we can close that, and we still get the same value, which is 0.04. Minus 0.04. Now that doesn't make sense, to be honest, because that's a negative beta, and negative beta would mean that in the equation that we had seen, if you are looking at a negative beta number in the equation RF plus beta into RM minus RF, theoretically you can get negative beta, practically we've received negative beta, but it doesn't make logical sense because this term will become negative, which means the return expected on the stock is going to be lesser than the risk-free rate, which doesn't make sense. So while the process of calculating beta is useful, what we have identified is that if you do that for Reliance and you use Sensex there, and we also have an issue with some sort of the data that is there, so it is possible that that some data is not correctly getting projected, and that is creating a small bit of an issue. But mechanical process aside, that negative number doesn't make sense, which brings us to the next method of beta calculation. It's good that we use this kind of data that gave probably a negative indication. I think there's some issue with the data as well that Yahoo Finance is showing, which could happen from time to time. So in general, that's a point where you would want to kind of go back and probably do this again with Reliance versus maybe Nifty. And maybe when you do it against the Nifty, you would probably get a separate value, or maybe do it for a separate set of dates, right? But what we just saw was a very practical example of how data could mislead us when we are doing a historical calculation, right? Now, I would urge you that you try it again on another stock, and there would be exercises that would come where you can try it on another stock with another set of data and try and just corroborate that data. You could also do the same calculations using data from NSE. So if you go to the NSE website, on the NSE website you could search for Reliance Industries, click on Reliance Industries. Here you get historical data. Click on historical data. You can get data for 3 months on this tab. If you want data for more than 3 months, you have to click here. You go to a page where you can enter the symbol Reliance, and let's say you want the data for the past 365 days. You can get the data for the past 365 days. You can also download the same data in a CSV file format. That link to download it is here, and you can open that and then use that data once again. Right, so this is again available as an instrument, and you could use this from the NSE and use these prices and try and regress these prices against the index value. Similarly, on the NSE website, you could go to products, indices, click on indices, go to historical data, and you get this index wise open, high, low volume. Search, select the Nifty 50, select the time period. In this, the only caveat is that you can do it only for 1 year at a time, but that's all we need any which ways, right? So we need it for, let's say, till this data. You can get the data here, and you can go down again, and you can download this data into a CSV file. That opens the CSV file, and that's the data that you have for Nifty now. Now that you have this data for Nifty and you have this data for the Sensex, you can go ahead for the company Reliance, you can go ahead and use and regress it once again. Right, so that's the beta calculation on a historical method. You could try these methods just to gauge whether you get relevant data or not. But that brings us to the second way of finding beta, which is called as the fundamental beta calculation. Now, why is this important? Is because sometimes we could get data like the earlier case where it doesn't make logical sense that a stock would move lesser than the risk-free rate. Or sometimes you may just not have price history for a company, right? There might be a case where a company has not traded in the past, so there is no price history available. In this context, what is important is that you try and find out if there is a fundamental way to calculate beta. It should ideally be driven by business decisions and the risk that comes in there, correct? The major determinants is basically what kind of business the company is in, and in a sense, what is the operating and financial leverage? Financial leverage is how much debt it carries. Operating leverage is, in a sense, what kind of fixed cost structure the company has. Why is that important? If a company has sales of 100 and fixed cost of 90, giving profit of 10, sales goes up by 10%. Remember, fixed cost will remain fixed. Profits go to 20. Sales go down by 10%. Fixed cost remains fixed. Profits go down to 0. In the first case, sales increased by 10%, profits increased by 100%. In the second case, sales decreased by 10%, profit decreased by 100%. In businesses which have high operating leverage, they have high fixed cost, right? Airlines, for example, whether one person is sitting in the airline or 100 people are sitting in the airline, the fixed cost is fixed. The cost of flying the aircraft is more or less fixed. Hotels, for example, whether one room is occupied or all the 100 rooms of a 100-room hotel are occupied, the broad cost of the hotel is fixed, right? Salaries, etc., have to be paid for the number of people who are already there. So in these kind of businesses, there is a bigger risk because a small change in sales can bring about big change in profitability. Now, when you're looking at beta, let's say there is a firm that has no price history. So you'll be looking at similar firms to get to the beta of that firm. In similar firms, the fixed cost structure is kind of fixed. Operating leverage is the same for most hotel companies, most airline companies, right? So the beta determination should primarily depend on what is the financial leverage or the loan that the company has. Now, in this case, the beta can be estimated using betas of other firms or average market beta. We also need to define two more terms, what is called as levered and unlevered beta. What we just calculated, the historical beta, which is coming from the market knows about the firm's debt equity ratio, that's called as the levered beta. If you try and arrive from this beta to the unlevered beta, that is the beta assuming that the firm has no debt. So if this company had zero debt, then the beta would have been calculated and that would have been an unlevered beta. Now, how do we go from levered to unlevered? There's a formula for that. But let's understand what we are trying to do here, right? We first find comparable firms in size and business. We then find the betas of these firms against a common index. We'll take an example that will become clearer. So let's say we are doing it for a company A. We're finding companies B and C which are in the same sector, similar size. We find the betas of B and C against maybe Nifty or any index. We find the unlevered beta by using the debt equity ratio. Now, unlevered beta is coming from this formula, levered beta, what you just calculated using historical data, divided by 1 plus the debt equity ratio. And because the debt gets you a tax shield, right? If you have an interest cost, you get a tax break on that because the interest gets removed from the profit. The debt has a tax shield, you multiply it with the tax shield, right? We'll take an example, it will become clearer. Then we find out, once you have found the unlevered beta for companies B and C, you take the average. So you get the average unlevered beta by average of those firms. And then once you get the sector average unlevered beta, you can re-lever it. You can re-lever it for the firm under question, which is the firm A, right? Let's take an example. Assume that you want to find the fundamental beta of a company. Let's say we want to calculate it for Vodafone. Vodafone is unlisted in India. It's planning to do an initial public offering, but at this point of time, it is not listed. So there are similar companies which are Idea Cellular and Bharti Airtel. The betas are given as 0.76 and 0.68. If you regress against the Nifty, these are the betas. The debt to equity ratio for Airtel is 32.32 and for Idea Cellular is 0.42. The tax rates are 30%. Let's assume debt equity of Vodafone is to be 0.25. So what do we do first? The first step is to find unlevered betas. If levered betas are not available, you have to first find levered betas. These are the levered betas for us, which are found from the market, right? How do you find unlevered beta? So beta unlevered is basically beta levered. Just remember that you're dividing it by 1 plus debt by equity. And because debt has a tax shield, you can use 1 minus tax here. That's what you're doing, right? So levered beta for Bharti Airtel is 0.68, right? So you take, in this particular case, you take 0.68 divided by 1 plus 0.32 into 1 minus 30%, right? So effectively that will give you as 0.68 divided by 1 plus debt equity is 0.32. 0.32 into 0.7 is going to be approximately equal to 0.22. So 0.68 divided by 1.22 is going to give you your beta. We're going to come and calculate this in a moment on the Excel file. Then for Idea Cellular, so this is for Bharti. For Idea, you can do the same calculation, which is 0.76 divided by 1 plus 0.42, because the debt equity is 0.42, 1 minus 30%. 30% will be approximately 0.3 or something. So 0.76 divided by 1.3. That's the unlevered beta for Idea. Let's use this to calculate. So unlevered Bharti and unlevered Idea. Let's calculate this. So that's 0.68 divided by 1.22, and that's equal to 0.76 divided by 1.3, correct? These are the unlevered betas. Now what do we mean by unlevered betas? Effectively, we are assuming that if Bharti did not have a loan, if Bharti did not have a debt, what would the beta have been? That's given here. Effectively, we are saying if Idea did not have a debt, this would have been the data. You look at them very similar. That's basically saying that if a telecom company did not have debt, they would have a beta of around 0.56, 0.57, right? Can we find the average unlevered beta? That's nothing but the average of these two, so that's going to be 0.57, correct? 0.56 and 0.58, that's the average. Now we will re-lever this using the debt equity ratio of Vodafone, which is 0.25, right? So now the formula changes itself on the other side. So let's rewrite this now. We are saying that the formula will change itself. We already have the unlevered beta now, and we have to multiply this with 1 plus debt by equity into 1 minus tax to get to the beta levered for Vodafone. Earlier we were dividing, remember, because we had the levered beta, we converted it to unlevered. Now we have to re-lever it. So we got 0.57 into 1 plus the debt equity is 0.25 multiplied by 1 minus 30%, and that's going to be the beta that we're going to use, right? So this will be 1.17 or something, multiply 0.57 by 1.17, and that's going to give us the data. We can also calculate it on the Excel file. Let's do that. So we're going to say levered for Vodafone based on the data that we have is 0.57 multiplied by 1 plus this into 1 minus 30%. We close the brackets and we get the beta as 0.67. We get the beta for this particular company, levered beta, as 0.67, right? Let's revisit what we did. So we picked up. So let's recap what we just did. We were to find comparable firms. We have to find the data for Vodafone. Vodafone is unlisted, so we have to find comparable firms which were Idea and Bharti. We find their betas from the index, so that's 0.76 and 0.68. We look at their debt equity ratio and we calculate unlevered betas for these guys, which was basically 0.58 and 0.56. We take the average, which is 0.57. We use the firm's debt equity ratio, which is 0.25, and tax rate, which is 30%, and use the same formula. We now have the unlevered beta, which is 0.57. We have the tax rate, we have the debt equity. This is what we are calculating for Vodafone. And once we calculate that for Vodafone, we find that the beta of Vodafone is 0.66 or 0.67 in a sense, right? That's the way to calculate beta fundamentally. It is useful if the company has limited trading price history. Let's say a company is doing an initial public offering, they're there. It is useful where statistical beta is looking to be giving you an error, like in our earlier example that we just saw, right? That's basically the beta calculation. Betas for Nifty 50 stocks is available here. Nifty actually now has 51 stocks. That's because Tata Motors also has another class of shares called differential voting rights. The discussion is beyond the scope of this section, but they both get listed. So that's why 51 stocks in Nifty 50. These are the betas. If you observe these carefully, there are certain observations. You will see that safe businesses like pharmaceuticals, fast moving consumer goods, the likes of HUL, Nestle, ITC, etc., have very low betas, right? So Sun Pharma, Lupin, Hindustan Lever, ITC have low betas. Cyclical and volatile businesses affected by global price moves like metals have high betas. Hindalco, Tata Steel, ONGC. Firms in sectors with high capital intensity and higher debt also tend to have higher betas. L&T, BHEL, capital goods, Adani Ports, infrastructure. Banks tend to have higher betas. That's because they work on a lot of debt equity ratio, right? So we can generalize the above findings into two learnings. Businesses with a lot of debt would be considered riskier, and hence businesses with a lot of financial leverage will have higher betas. Businesses with huge fixed costs known to have high operating leverage are going to be considered riskier or more risky, and they will also have a higher beta. So we have seen that in this data, typically businesses with huge fixed cost and cyclicality, businesses with debt have higher betas. Businesses which are safer, less debt, low fixed cost, more variable cost have lower betas in general, right? That's the understanding we need to have for beta. The couple of questions as we kind of close this session. What kind of businesses do you think will enjoy lower betas? And assuming the debt equity ratio of L&T to be 0.5, tax rate at 30%, levered beta as 1.33, calculate the unlevered beta of the firm.